Welcome back. This video is about points of interest. Basically, a point of interest is nothing more than a price where a reaction is likely to occur. This can be literally anything like a blocking zone, a break, either a continuation break or a reversal break, but in short, anything that can induce a reaction. Now, how do you know which one you pick? This might be kind of counterintuitive, but with my concepts, it doesn't really matter that much because my concepts have a high risk ratio. That doesn't mean they're inherently high risk. It just means that the ratio between risk and reward is pretty high. Now, I did that on purpose. Now, that allows you to lose multiple times in a row and still end up with a profit. I don't like losing money and I love making money. So naturally, my concepts are a high ratio. So you can risk a little bit of money and make a lot. Let me show you an example. I'm going to do everything wrong on purpose to show you that it really doesn't matter that much. Let's pick this reversal as an example. So this looks something like a reversal. We got low, we got shallow lows, we got breaks. So we are going to be targeting that high right there. So let's go through this. We have a break, another break, which validates this point of interest right there. And we enter on top of that zone right there. Stop loss slightly below, targeting the target. Now this is a loss. So let's mark that as -1 unit of risk. So let's continue. And disregard the fact that this is about 4 in the morning. I wouldn't be trading then, but keep in mind that this is just a demonstration. So the next one is a low and a high, which validates this point of interest right there. And we can wait for that to get hit, and we will set an order top below the zone and targeting the same target. As you can see, this was also a loss very quickly. Even if you widen this up, it wouldn't have mattered that much because it went down anyways. So let's continue. The next one is right there. A low broken, high broken, validating this zone right there. And let's set an order again on the top of that zone. Stop loss below the zone, targeting the same target. Now this is expectedly also a loss, so let's continue. Let's see what we got. We got a reversal break right there, which broke that high. All right, let's draw out our point of interest on the top of the zone. Stop loss below the low, targeting the same target. And it played out. I forgot to annotate these as well. 1 unit of risk right there, 1 unit of risk right there, and 35 units of risk right there. So even though we lost 3 times in a row, we still made money. Matter of fact, you could have lost 34 times in a row and still made money. So which one do you pick? It really doesn't matter. As long as you're making more than you're risking, it doesn't matter. Let's look for another example, because maybe this doesn't quite get my point across. Let's take this big move as an example. Generally speaking, which one do you pick? If you kind of want to optimize it, in my experience, if the price is really choppy, tend to pick the extremes, right? If price is really strong, you kind of pick the higher ones. But let's say you mess all of that up. Let's imagine you want to trade this move. So you pick this spot of turbulence as a point of interest. Guess what? It's going to fail. Top below the low, targeting the high. You're going to get stopped out. What do you do if that happens? I promise it's not a trick question. You use the one below it. And guess what? You get stopped out again. Let's say you do nothing else. You just look left at the moves that happen and mark out points of interest that you trade off. Let's go down further. Set another order. Stop below the zone, targeting the high. And you get stopped out again. Then what do? Keep going lower. The next zone. I mean, didn't even really have a chance right there. Stop below the zone, targeting the high. Basically an instant stop out. Totally fine. What do? You keep going down. Order right there. Stop below the zone, targeting the high. And eventually it hits the target. All right, exhibit B. You lost 4 times in a row. You did nothing. You used no concepts at all. everything went wrong. So you're now down total of 4 units of risk. And then it plays out. Even though everything went wrong, you still ended up with basically 20 units of risk. So that equates to a net profit of 16 units of risk. So even though everything went wrong, you still have a 1 to 4. Why is it a 1 to 4 and not a 1 to 16 or a 1 to 20? Well, because you have to take these into account. So let's imagine you are on a 10 grand account and you're risking 1%. I wouldn't really advise 1%. I think it's way too much. But even with basic risk management, I don't think I've ever mentioned this before, but risk management is vital. Without risk management, you have nothing. You can win 90 times back to back. Without risk management, you will lose everything with one mistake. Don't let that be you. All right, let's break this down. You are risking 1%, $100 on a 10K account. So your risk per trade is $100. Your total drawdown is going to be $400. And then right there, you make 20 risk units, which is 20 times your risk, or in this case, 2 grand. Now you subtract the drawdown from the total win, and you end up with a 16 unit of risk profit, or $1,600 roughly. So 2 instances, one where you use concepts and one where you didn't. You just marked out points of interest, and in both cases, you still made money. I can make a dedicated video on risk management because this is not even scratching the surface. I think the risk management videos currently out there are lacking at best. So if that interests you, let me know and I will make a dedicated risk management video. But this just goes to show it doesn't really matter. If you're trading my concepts, you can do everything wrong, and as long as your net is positive, you end up with a profit. And yes, as you gain experience, you kind of flesh out which ones you should take and which ones you shouldn't. And then you just end up with more profit. But it is totally fine to lose. It is totally fine. Actually, being able to lose just shows that you kind of know what you're doing. Because if you can control your losses, I mean, what else is there? Protecting your capital is probably the single most important thing in trading. Anyways, that was it for today. A quick little video on points of interest, what they are, how you can trade them, and if you're trading my concepts, that it doesn't really matter which one you pick. But if you want to optimize, generally speaking, if it's more choppy, I tend to go for the extremes. Extremes meaning the lowest or highest. And if it's more of an actual formation, you can use higher ones. And the opposite is true. If it's going down, you use the higher ones. And if there is a formation going down, you use the lower ones. Anyways, that is it. If you have any questions, leave them in the comments. They are open. And with that, I hope you have a great rest of your day.